All right, today we're going to dig into KULR Technology Group. This is a company with, well, kind of a split personality. On one side, you've got this high-tech innovator with incredible growth, but then you flip the coin, and the financial story is something else entirely. It's pretty wild. And this is really the heart of the puzzle we're trying to solve today. Check this out. In their 2025 fiscal year, KULR's revenue shot up by a massive 51%. I mean, that's a huge win, right? But at the very same time, they posted a staggering $62 million net loss. So how is that even possible? How can both of these things be true at the same time? Soaring sales and a massive loss? Well, to figure it out, we've got to look at the two very different sides of this company's business. Okay, first up, let's talk about side one, the tech innovator. This is KULR's day job, so to speak. And what they do is build some seriously high-stakes technology for some of the biggest names in aerospace and defense. So, at its core, KULR is all about one thing: batteries. But not just any batteries. They design these super advanced systems to solve two really critical problems: keeping ultra-high-power lithium batteries from overheating and, catastrophically failing. We're talking about some of the most extreme environments you can possibly imagine. Their main thing is this platform called KULR 10R. Think of it like a modular battery system that they can adapt for all these different super critical sectors. You've got KULR 10R Space for spacecraft, KULR 10R Guardian for the military, KULR 10R Air for things like drones and those cool futuristic eVTOL aircraft. And listen, this isn't just some theoretical tech sitting in a lab somewhere. We're talking about hardware that's trusted by absolute giants like NASA and Lockheed Martin. Their stuff is literally flying in space right now. It's on the International Space Station, and it's being developed for things like hypersonic vehicles. Pretty serious stuff. All right, so that's the tech innovator side. Super impressive, right? But remember, that's only one side of the coin. Now we need to flip it over and look at the other side, which has absolutely nothing to do with building batteries and everything to do with digital currency. Yeah, this is where things get really interesting. Because while they're doing all this amazing engineering work, KULR has made this huge strategic decision that completely changes how you have to look at their finances. Instead of just keeping their cash in a regular old bank account, they've gone all in on what's called a Bitcoin treasury strategy. So what does that mean? It means they're taking a big chunk of their company's money and using it to buy and hold Bitcoin. They see it as a long-term store of value, a way to hedge against things like inflation and global instability. It's a big, bold move. And they're not just, dipping their toes in the water here. As of the end of 2025, they were holding just over 1,000 Bitcoins. That is a substantial position. And get this wasn't a small bet by any means. The total purchase price for all those coins was over $100 million. For a company KULR's size, that is a huge commitment. Okay, now here's the number that you really need to pay attention to. Their average purchase price, when you factor in all the fees, came out to about $100,600 per Bitcoin. Keep that number in your head. And here's where you can start to see the problem. They paid, on average, over 100 grand a coin. But by late March 2026, the market price had dropped to just under $66,000. That's a difference of over $34,000 on paper for every single Bitcoin they own. Ouch. Okay, so let's connect the dots here, right? We've got this growing, innovative tech business on one side, and this really volatile financial asset on the other. So now let's see how this big Bitcoin bet actually impacts their bottom line. So first, let's look at just the core tech business. The operating loss grew from about $15 million in 2024 to $43 million in 2025. But you know what? That was kind of expected. They were pouring money into R&D and expansion to fuel that amazing revenue growth we talked about. But hold on, $43 million? That's a long way from the $62 million net loss we saw on that first slide. So where did that extra almost $20 million in losses come from? What's bridging that gap? Well, the answer is right here. It all comes down to the fourth quarter. The biggest reason for that huge net loss was a single non-cash accounting charge of over $28 million. And where did that charge come from? You guessed it. The falling value of their Bitcoin. It's called a mark-to-market loss, and it hit them hard. And hey, you don't have to take my word for it. The company's own CFO, Sean Cantor, basically said it himself. He pointed out that the net loss included these significant non-cash charges. That's the Bitcoin write-down, on top of their planned investments for growth. So here's the really crucial takeaway. This Bitcoin strategy, it adds this whole new layer of volatility right on top of all the normal risks that a young tech company has to deal with. I mean, think about it. They're already juggling things like needing more funding, relying on just a few big customers, and dealing with these really long and complicated sales cycles. So, where does this all lead? How does this crazy two-sided approach fit into their grand vision for the future? What's the big bet they're trying to make here? When you really boil it down, KULR is making a huge bet on two completely different futures at the exact same time. It's a bet on technology, that their amazing battery systems are going to own the market in these critical industries. And at the same time, it's a bet on finance, that Bitcoin is going to be a much better place to park their money for the long term than just plain old cash. And that really leaves us with a big final question, doesn't it? Is what KULR's doing a visionary leap into the future? I mean, if both of these bets pay off, it could be massive. Or is it just a huge high-stakes gamble for a company that's still got to focus on growing its main tech business? I guess only time will tell.